Karen's one of the first substantive items on there, but I think we've got a number of questions that we have to go through. So
take a while answering the questions. So,
yeah.
So yeah. Okay, thank you very much. We'll go live. Firstly, I'd just like to start off by saying who we all are, checking who's available and not. So obviously, I'm Councillor Andy Canning. I'm the chair of the Pensions Committee. Peter, are you with us today as well?
I am Councillor Peter Wharf. I'm the vice chair of the committee.
Thank you. John Beasley.
Councillor John Beasley, one of the representatives from Bournemouth, Christchurch and Poole Council.
Okay. Councillor David Brown.
Yeah, David Brown. I'm a councillor for Bournemouth, Christchurch and Poole Council.
Councillor Simon Christopher.
Hello, good morning. I'm Simon Christopher. I'm an economics graduate. I'm a councillor for the Marshwood Vale and a chartered accountant.
Councillor Bobby Dove.
Good morning. I'm a councillor for BCP Council.
Good morning. Adrian Felgate.
Good morning, Adrian Felgate. I'm the scheme member representative.
Councillor Howard Legg.
Good morning, everyone. Dorset Council.
Councillor Mark Roberts.
Good morning, everyone. Another Dorset councillor.
Okay. Also we've got Alan Saunders, our independent advisor.
Good morning, Alan Saunders. I am the independent investment advisor on behalf of a firm called MJ Hudson, based in the City of London.
Okay. Aidan.
Good morning. My name is Aidan Dunn. I'm an officer of Dorset Council. I'm the Section 151 officer.
Jim McManus.
Morning, everybody. Jim McManus. I'm Corporate Director for Finance and Commercial with Dorset Council.
Karen Gibson.
Good morning, everybody. I'm Karen Gibson. I'm the Service Manager for Pensions, looking after administration and the local pensions board.
Okay, David Wilkes.
Morning all, David Wilkes. I'm the Service Manager for Treasury Investments for the Administering Authority, Dorset Council.
Okay. And is Charlotte Eggleston with us as well?
I think Charlotte is listening in. I don't know if Charlotte, I think she's behind the scenes, so I'm not sure if you're there.
Okay, just explain. Do you want to explain the change of position for Charlotte?
Yes, so briefly, we've appointed Charlotte Eggleton was Peach as effectively my deputy in the team, and we've also now backfilled Charlotte's been a member of the team for probably 4 or 5 years, an excellent member of the team, and we've backfilled her position with another internal appointment from another part of the Dorset Council financial and commercial area, a chap called David Perry, who's joined the team as well. So hopefully these changes will start to build a bit of resilience within the team, and so Charlotte you'll have more visibility of Charlotte as meetings go on.
Okay, thank you very much. Right. Just a statement to start off with. In the light of the increasing COVID-19 case rates and projected increases through August and September, in consultation with group leaders, Dorset Council's Chief Executive has exercised his emergency powers to revert to informal virtual meetings. Where a decision is required, committee members will express a minded to decision in respect of recommendations set out in officer reports, with decisions being made under officer delegated authority in the light of minded to decisions expressed by members in the virtual meetings. Accordingly, this meeting has those arrangements in place. If anyone wishes to speak during the meeting, please can they type RTS in the chat bar. So that stands for request to speak, but please use the chat bar rather than raising a virtual hand. Okay. First item on the agenda is apologies. I guess we don't have any because we all seem to be here, so that's very good.
Correct.
Item 2 is the minutes of the meeting held on the 15th of June 2021. Does anybody have any issues with those minutes? So you're happy that they're a true, correct record of the meeting, and at some point I'm going to have to come and arrange to sign them because there must be a bit of a backlog of minutes that need signing from the last few meetings. Are there any declarations of interest? No. Okay, good. But moving on to item 4, public participation. We have received a total of 6 questions this time round, because they're slightly more varied than the last time and not quite as many as last time, we've taken the decision to answer them all individually at this stage, rather than what we did last time round, which I think is an unusual position of answering them all later by writing. So the procedure is that David will read out the questions and then I will provide the answers. David, over to you.
Thank you, Chairman. The first question is from Vicky Elcote. Councillor Canning told me earlier this year that the data in the UK Divest report for Friends of the Earth of February 2021 was out of date for Dorset Council. He said that since those figures which related to the 1920 financial year, Dorset Council had undertaken a major strategic review of its pension fund investments. He promised an update after March 21. The question is, what is the current amount of investment in fossil fuels? I understand these are indirect investments. The figures provided by the Friends of the Earth report are for the amount in pounds of investments and the percentage that it is of the overall investments. It would be useful to have it in the same format to compare. So this is not a question about the carbon footprint or the carbon intensity of the investments. The figure in the Friends of the Earth report was 128 million in indirect investment in fossil fuels. This put Dorset in the top 10 of local authority pension funds for fossil fuel investments. What is the current figure?
And my answer is, as part of the government's requirement for local government pension schemes fund to pool investments, the Dorset County Pension Fund no longer holds direct investments in companies. Instead, the vast majority of its equity investments are now in pooled investment vehicles managed by Brunel Pension Partnership, the LGPS investment pooling manager set up and fully owned by the administrating authorities of 10 LGPS funds, including Dorset. Brunel regularly publish details on their website of the underlying holdings in all their pooled investment vehicles. Using this information, officers have estimated that the value of the pension fund's investments as at 31st of March 21 in companies primarily involved in the exploration, production, mining and or refining of fossil fuels was approximately £41 million. So which is 1.2% of total investment assets. Question 2.
Question 2 from Tracy Cozzi. It is clear that that pension funds exposed to the fossil fuel system in the coming decade will face a rollercoaster ride of disruption, write-downs, financial instability and share price deratings as markets adjust. Does Dorset Council see itself as ultimately responsible for any loss incurred to themselves and their pension fund members by refusing to insist on 100% divestment from fossil fuels now, or are Brunel Investments responsible?
And my answer is the Dorset Council Pension Fund is part of the LGPS, which is a national pension scheme administered locally. It is a defined benefit scheme, which means that benefits for scheme members are calculated based on factors such as age, length of membership and salary, not investment performance, as they would be in a defined contribution scheme. Dorset Council is the administrating authority for the LGPS in Dorset, which provides pensions and other benefits for employees of Dorset Council, other councils and a number of other organisations within the county. DC has delegated its responsibilities as administrating authority to the Pension Fund Committee, which consists of 5 Dorset Council elected members, 3 Bournemouth, Christchurch and Poole Council elected members, and 1 scheme member representative nominated by the trade unions. Administrating authorities are required to maintain a pension fund for the payment of benefits to scheme members funded by contributions from scheme members and their employers, and from returns on contributions invested prior to benefits becoming payable. The Pension Fund Committee has the duty to scheme members and their employers to ensure that their contributions to the pension fund are invested appropriately to make returns sufficient to meet those obligations, and this duty overrides any other considerations. The Pension Fund Committee agree the investment strategy for the pension fund They engage in external investment managers, including the Brunel Pension Partnership, to deliver that strategy. But the committee remain responsible for the pension fund's performance. We do not restrict our investment managers from investing in specific companies or sectors, but they must consider all financially material risks relating to their decisions, including the risks you highlight. Also, in order to reduce its exposure to sector-specific risks, such as those you have highlighted, the pension fund holds a highly diversified portfolio of investments across sectors, geographic regions, and asset classes. A year ago, the committee discussed and agreed our current investment strategy, including a lengthy debate between divestment and decarbonisation. If we had followed a divestment strategy and sold all of our fossil fuel energy stocks, this would have reduced our carbon footprint by 19%, but we opted for a decarbonisation strategy. This resulted in 20% of our equity investments being switched into a low carbon global fund targeting a 64% reduction in our carbon footprint and committing all of our remaining actively managed equity investments to a 7% per year reduction in carbon usage over the next 3 years, so 21% overall. So while the policy of divestment from all fossil fuel extraction companies may sound better, it will actually result in a higher carbon footprint than the policy we are currently following. Divestment from companies means that we sell our holdings to other investors. It is a transfer of ownership that does not directly lead to a reduction in either the supply or demand for fossil fuels, but it does remove the opportunity to influence companies by working with them to transition to a lower carbon future. Targeted divestment remains an option for individual companies who will not positively engage. And question 3.
Question 3 from Linda Dean. I am a Dorset County Council pension fund member and I do not want my money to be invested in companies that make money from fossil fuels for environmental reasons, given that we are all facing a climate emergency. On June 1st, 2021, in a money saving expert environmental poll on how important is protecting the environment to you, the top choice for all age categories was, I'm happy to pay more and make changes for green options. I choose environmentally friendly green energy providers for my utilities and ensure environmentally sustainable criteria are in place before making any other financial investments where possible. I would therefore like my council pension fund money not to be invested in such companies. There must be other DCC pension fund members who feel as I do at this critical time in our global climate situation. Will Dorset Council commit to polling all its pension fund members to see whether a majority would prefer to divest from companies that profit from fossil fuels and to put their money in ethical green investments, or ask whether they are happy with the current use of their money?
And my answer is the LGPS is a national pension scheme administered locally. Dorset Council is the administrating authority of the LGPS in Dorset, which provides pensions and other benefits for employees of Dorset Council, other councils, and a range of other organisations within the county. Dorset Council has delegated its responsibilities as an administrating authority to the Pension Fund Committee, which consists of 5 elected Dorset members, 3 Bournemouth Cross Johnson Pool Council elected members, and 1 scheme member representative nominated by the trade unions. The LGPS is a defined benefit scheme, which means that benefits for scheme members are calculated based on factors such as age, length of membership, and salary, not investment performance, as they would be in a defined contribution scheme. Administrating authorities are required to maintain a pension fund for the payment of benefits to scheme members funded by contributions from scheme members and their employers, and from returns to contributions invested prior to benefits becoming payable. Contribution levels for scheme members are set nationally, and contribution levels for scheme members are set locally by actuaries engaged by administrating authorities. As scheme member rates cannot be changed locally and benefits are defined, the risk of investment underperformance is effectively borne by scheme employers. For the reasons set out above, scheme members cannot have different investment options available to them, as could be the case with a defined contribution scheme, where the risk of investment underperformance is borne by the individual scheme member. Membership of the LGPS, however, is not compulsory, and employees of scheme employers can choose to make alternative pension arrangements that would allow greater control over how their contributions are invested. However, we would strongly recommend that anyone considering such an approach takes appropriate independent advice before doing so. Okay, then on to question 4.
Question 4 from Sandra Reeve. As one of the direct actions within their climate and ecological emergency strategy, will Dorset Council's Pension Fund Committee be asking Brunel Pension Partnership to adjust and cease their investments in fossil fuels in order to meet Dorset Council's own net zero by 2040 target rather than Brunel's stated net zero 2050 target? I read the transcript of COP26 President Alok Sharma's speech at the first Net Zero Pension Summit published June the 1st, 2021, in which he says, "Today, green investments are smart investments. In the majority of the world, renewables are cheaper than new coal and gas. Putting your money in fossil fuels creates the very real risk of stranded assets." He then supports and urges financial institutions to take the following steps. First, commit to exit coal finance, so that together we make COP26 the moment we consign coal power to the past where it belongs. Second, increase investments in climate action in developing and emerging markets. Thirdly, protect nature. By 2025, ensure none of your investments contribute to deforestation. And by 2030, ensure your investments are contributing to the restoration of the natural world. Finally, disclose your climate risk in line with the Task Force on Climate-Related Financial Disclosures, and points out that this will become mandatory across most of the UK economy in 2023. And the government will shortly introduce regulation on what this means for pensions to ensure trustees take account of climate change risk in each and every decision. There is a real advantage in getting your house in order and early, and that in this vital year for climate action, the year of COP26, you are playing your part in keeping 1.5 degrees alive. Will Dorset Council urge Brunel to sign up to the Glasgow Financial Alliance for Net Zero, along with other major pension schemes such as Aviva, BT Pension Scheme and the Church Commissioners of England, in particular to fulfil the requirement that by 2030 they can assure that their investments are contributing to the restoration of the natural world?
Okay, and my answer is you are correct in stating that Dorset Council has committed itself to a net zero 2040 objective. We are committed to working with partners to achieve this target, and that includes the Brunel Pension Partnership. Brunel are widely recognised as a market leader within this field, and their website includes a wealth of information relating to its engagement activities with companies, including voting records. In 2022, Brunel will complete a stocktake of their approach to engagement and divestment. If this review concludes that companies are not taking appropriate action and sufficient steps to manage climate risks and enable alignment with the Paris Climate Agreement, then the committee will need to reconsider its approach too. Brunel is a member of the Institutional Investors Group on Climate Change, which means that they are automatically signed up to the Glasgow Financial Alliance for Net Zero, and Brunel's Chief Investment Officer, David Vickers, is a member of the Real Economy Transition Workstream, which forms part of this alliance. Brunel are also a signatory to a similar initiative, the Net Zero Framework, NZIF, launched in March 2021 with the aim of helping investors become Paris aligned. Then on to question 5.
Question 5 from Julianne Booker on behalf of Dorset Action on Pensions. As a coordinator for South West Action on Pensions, I have recently heard from Brunel Pension Partnership that as part of their upcoming climate stocktake consultation this autumn, they will be taking views from others than just the 10 principal council environment agency stakeholders. Given Brunel are opening up the conversation about its investment portfolios, to complement this exercise, will Dorset County Pension Funds Committee now consult its own pension members' views, in particular on the question of ongoing and planned future investments in fossil fuel companies?
And my answer is the local government pension scheme is a national pension scheme administered locally. Dorset Council is the administrating authority for the LGPS in Dorset, which provides pensions and other benefits to employees of Dorset Council, other councils and a range of other organisations within the county. Dorset Council has delegated its responsibilities as an administrating authority to the Pension Fund Committee, which consists of 5 DC elected members, 3 Bournemouth, Christchurch and Poole Council elected members, and 1 scheme member representative nominated by the trade unions. Administrating authorities are required to maintain a pension fund for the payment of benefits to scheme members funded by contributions from scheme members and their employers, and from returns on contributions invested prior to benefits becoming payable. The committee has a duty to scheme members and their employers to ensure that their contributions to the pension fund are invested appropriately to make returns sufficient to meet those obligations, and this duty overrides any other considerations. Members of the public, including scheme members, can make their views known on any matter relating to the pension fund, including those you highlight, by submitting questions or statements to this committee. A wider consultation would be a costly and time-consuming exercise, which we do not believe is needed. Now on to question 6, which is the final question.
Question 6, again from Julianne Booker. Dorset Pension Fund Committee last met on 15th June 2021. Since then, on August the 9th, the Intergovernmental Panel on Climate Change published its 6th report. UN Secretary General Antonio Guterres said that the report signals code red for humanity. The report provides new estimates of the chances of crossing the global warming level of 1.5 degrees in the next decades, and finds that unless there are immediate, rapid and large-scale reductions in greenhouse gas emissions, limiting warming to close to 1.5 or even 2 degrees will be beyond reach. We are seeing now almost daily reports of the effect of climate change on communities around the world. In recent days, New York and New Jersey. A few weeks ago, it was Germany and Greece. There's been lives, homes and livelihoods lost. We have seen the destruction. A key driver for climate change are the fossil fuel companies and the financial industry that supports it. Fossil fuel companies remain huge polluters, producing and selling fossil fuel products, while scientists say we need a mass switch to renewable energy and efficiency. We have the technology to move to renewable energy sources and should be using all available financial resources to make this happen, including pension fund financial assets. Fossil fuel companies are responding to the climate crisis with green marketing, while their core business remains fossil fuels. Their adverts are using greenwashing to distract the public from the harm their products cause to people and planet. Some of us are old enough to remember when giant tobacco companies did the same after the irrefutable damage their products caused were exposed. They carried on sponsoring sporting activities in the hope we would all think they were doing something good, so could be excused all the damage they were responsible for. Dorset Council's strategy, agreed with their investment managers Brunel Pension Partnership, is to divest at 7% per year, so it will take 15 years to divest completely, taking us to 2036, hardly reflecting an immediate or rapid response to contribute towards large-scale reductions in greenhouse gas emissions. In the words of Alex Sharma, who is leading the coming COP26 climate summit, the world is dangerously close to running out of time to stop a climate change catastrophe. We can't afford to wait 2 years, 5 years, 10 years. This is the moment. Given the IPCC report has been published since the last Dorset Pension Fund Committee, when will the committee be tabling an agenda item to discuss the report and its warnings against the backdrop of the current Dorset Pension Fund investment strategy?
Okay, my answer is pension funds, by their very nature, are long-term investors seeking returns that will cover the pensions of their members. It is not in their nature to respond to short-term events. The Dorset County Pension Fund's investment strategy is driven by an actuarial valuation that takes place every 3 years. This valuation examines a whole range of factors, including how long our pensioners are likely to be claiming for, plus future rates of inflation and interest rates. Once we have this information, we can make decisions on the appropriate levels of risk, asset allocation, liquidity of investments, sustainability, etc. The next triennial valuation will be based on the situation in March 2022. We would aim to discuss its recommendations and review our whole strategy by the end of next year. This also fits in with Brunel's timetable to review its sustainable policies in 2022. The Dorset County Pension Fund has already made great strides in reducing its exposure to fossil fuels. The Friends of the Earth report estimated that we had £128 million invested in fossil fuel production in 2019, and this has reduced to £41 million in March 2021. Okay, that completes the questions and the answers. Councillor Beasley has raised a point in the chat box about circulating these answers relatively quickly. Last time round, we agreed they would go out with the minutes, but unfortunately that means that members of the public have to often wait a couple of months before they actually get to see them. So I wonder if, David, you could speak to member services and see if there's any way to get these answers put up on the website fairly quickly. Is that okay?
Will do, Chairman.
Thank you. All right, then moving on to questions from members. We have no questions that I'm aware of.
That's correct.
Okay, urgent items. I'm not aware of any urgent items.
I'm not aware of any urgent items either, Chairman.
Okay. Then item 7, pensions administration. Over to you, Karen.
Hello, everybody. Hopefully you've all got a copy of the latest administration report. I'll briefly run through the main points for you. I try to keep it very relevant to what you will be specifically interested in and what's happening. The first thing to note is our usual report on our performance indicators is not included, and that's because of our change in the system. We're not yet in a position to provide that because of we're simply changing over to our new system. And for reasons that I'll explain as well when we look at item 11 on the report, which is the systems implementation. So you'll all be aware that we've undergone quite a transformation in how we work, bringing in a new system that has affected every aspect of how we work. And it's worth noting as well that this has been completed in record time. I don't think the company that we're getting the system from has ever implemented a system in such a short space of time. We did not have long due to the expiry of our previous contract. We're also the first authority that has ever taken the plunge of introducing the two portals, that's the member portal and the employer portal, and the main administration system at the same time. We literally went live with all three within a couple of days. And we've also, of course, been the first authority to do all of this virtually. We've not been able to meet with these colleagues, we've not been able to visit other colleagues and other authorities, and we've not been able to have floor walkers. So that's given us additional challenges. So moving on to the new system, it is now live, and it went live on the dates as expected. The main system went live a couple of days earlier, and it's generally overall working very well, and it's going to give us a lot more functionality going forward, much more modern technologies that we'll be able to use, much more conducive to home working than we ever were before. You'll be aware that previously we are still working on the basis of paper files. Now everything is scanned and imaged, so the technology is much more modern and advanced. There's a lot more in the way of audit measures as well, complete audit track from everything that is done, which is very useful to us for a number of reasons. And it is a system that very much is developed by individual authorities. It doesn't necessarily come as a package, and that's how it is. It's something that you develop yourself to your own requirements. And we will continue to do that over the months and years as needed. As mentioned, we do have the member and employer portal as well. We also have what is quite essential to us, which is a really good workflow system. And now that workflow system links into the employer portal. So the employers will go online to a portal, they will submit individual pieces of information. They might notify us of a leaver or a death. They can also submit monthly files and financial information and data. And it's secure, it's easy for them to use, it tells them what they've done, and it also gives them prompts as to what they need to do in each month as well. And we are now using that system to communicate with them rather than through emails from individual staff members, so that the employers have a one-stop shop for everything pension-wise, and that sort of gives them no excuse to miss things and miss emails and communication. So as mentioned, we've now got an integrated scanning and image functionality. So we're no longer using an external scanner, and we can do everything in-house, which is quicker and more secure as well. The work is all integrated into a series of processes. So the workflow is actually a process of work. So before we had all these things separate, they're now all joined together. So it's a very different way of working for the team than before. The development of these individual work processes has taken far more time than we envisaged. They didn't arrive in a state that we could use them immediately. The testing processes took a lot longer than we anticipated, and we are continuing to refine them as we go along. So this is one of the reasons why we've not been able to produce KPIs this month. That and also the migration of our work cases. So we've migrated all the detail from historic cases. That's quite essential for future reference. That's all been done very successfully and clearly. And we've migrating and in the process of migrating more of our old images so that everything will be in one place. There was just over 4,000 active work cases that had to be transferred from the old system to the new, and that was quite critical and quite difficult. I'm very pleased at how it has worked out, and it's working well, but unfortunately it did mean that there had to be manual intervention for all of those cases. Following on from the blackout period, we couldn't use either system. Our workload has increased and we have got backlogs in some areas, including some critical areas. It's been really difficult for the staff to keep on top and do all this additional work on top of getting used to the new system and dealing with the business as usual. But I can't underestimate how much work has been done and achieved. It's huge, and it's going to be, of course, inevitable that there will be an impact to the service when you're making such a huge change as we have done. So the team have been fantastic, and I think I really would like to acknowledge what they have done in very difficult times. Majority of our team are working from home. We do have some people coming in to the office one day, but that's made it very difficult indeed. The employer portal is one of the things that I do value quite particularly. Not all funds provide an employer portal. So this is the portal that all of our employers use. They really like it. It's secure. It means that nothing is lost. But not all funds actually use this. I was talking to a fund yesterday that still just relies on employers doing their own reports and sending things, individual forms electronically. So you have no track of leavers and joiners and changes and that sort of thing. We're trying to make everything much more automated and easier for the employers so that things aren't missed, so we meet the expectations of the pensions regulator, and the benefits that we pay are correct and that members are confident in that. So the employer portal to me is extremely important, and that's working very well. The member portal, it was not as good as our previous portal, and we are in the process of making changes and developments to ensure that it is as good as, and in some cases it will be better than our old portal. So some of those things are still ongoing. It does give us some additional functionality anyway that our old portal didn't. So for example, members can upload documents from home securely. So that would have been extremely useful for us 18 months ago at the beginning of the pandemic, but that's quite popular with members, and that is there for us. So all in all, it's been very difficult. It's been a challenge, but it's a very positive change, and there is an impact, and that will be short term, and we will hope to get back on track with our service in the coming months. Before I move on to data quality, does anybody have any questions?
Doesn't look so, but I just want to say on behalf of all the members there, I think we do greatly appreciate the work that you and your team have put in this very difficult time to make so many changes and things that will improve our systems in the long run. But to do all of that and cope with the after effects of COVID is very impressive, and I think we're all very grateful for the work that you and the team have put in.
Thanks, Andy.
If you want to carry on to the next bit. Oh, David, sorry.
Yeah, thanks, Chair. Just a quick question, Karen. I know from the report and from what you've just said there, reporting on it, you talked about the sort of historic information. So just to clarify in my mind that obviously we've got this new system that's come in and all members have been transitioned onto the new system and all the data, but their sort of historic contact with the pension fund in terms of, I don't know, whatever it may be, any transactions that have gone on in the past, that's all coming to the new system as well, so that when you're in the pensions administration team and looking at details of member, you've got all of that history in the new system as well. Is that right?
It is. It's really important, actually. It's particularly important when there are disputes or complaints. And the disputes and complaints we sometimes get can be years after something has happened. It could be over a membership date. It could be over something, you know, somebody comes to retire and they say, well, this isn't right from 20 years ago. So we keep everything. We literally do in pensions. We're quite terrible. Our data retention policy allows us to keep information for 100 years. So what is quite crucial is those old workflow comments, when things were received, what members said and what was done. And I am pleased at how they have managed to transfer that, because I deal a lot with disputes that arise, and that's really, really important, as well as the historic just documents and information. It's not been easy. There are some things that we would have liked to have kept, but we know that they should be. Any important things should be on the member's file. So we are pleased at how it's done, and that has all transferred over.
Thanks.
Okay. I'll just move on to data quality. This is something that we cover each year with you. And what we do and what we have done previously is used our previous provider to run reports for us. Now, these reports are required by the pensions regulator. So all pension schemes, not just public sector schemes, have to report on the quality of their data. And we then use that information to work on areas of improvement for the coming year. And these figures are so it's a reflection on how well we do. So there's two areas of data that they look at: common data. So this is data items that are applicable to all pension schemes. So this, everybody will be reporting on this. And the overall score for tests for the Dorset Fund was 99.4%, which was exactly the same as the 2020 results. So that's excellent. The scheme specific data is specific to the LGPS. And our score for that was 98.9, which is a slight improvement over last year of 98.2. These scores would be unrealistic if they were 100%, because, for example, one of the common data items is to have a current address. And that's really quite difficult for deferred members particularly. We struggle to get up-to-date addresses from our deferred members. But as you can see, we do put in a lot of effort. We send our deferred members one communication a year, and that often prompts members to let us know an address. It just reminds them that they've got a benefit there. So this is all a really good picture. This picture was prior to our change in system. Now, one of the things that we've done changing our system is we're doing a lot of data checks. And one of the biggest things that we have done is we've asked Civica to run on the entire fund, deferred and active members, annual benefit statements, and then make comparisons. And this has been a huge piece of work, but it's been really important because it has shown up a number of errors. And we're working with Civica at the moment, and we will be over the next few weeks, to look at these. So when you transfer data, you transfer each individual item from the previous system into the new one into a specific field. But these systems do work differently, and there are things that we have to change. So what we're trying to do is preempt any issues. We asked for these checks to be done so that we can go into the valuation next year with confidence about our data, and of course, importantly, issue annual benefit illustration statements next year with confidence, because those things are often where problems arise, because of the transfer of data can be so complex. So there is a lot of work to do on our data, and because we have been so particularly good in the past, we are quite desperate to make sure that we maintain that going forward. And in the future, next year, we hope to start bringing in an integrated payroll system, and that will improve our data quality again. So we will endeavour to make sure that our data quality results remain high. Moving on, does anybody have any questions in regard to those reports? No. Okay, I'll move.
Councillor Christopher, you're muted.
Yes. One small question that may appear naive. Are you aware of HMRC Connect software?
I don't think so.
I.e. the HMRC Connect program, which is essentially used to detect fraud. And what it does, it draws in information about all individuals in the country, whether it's planning application, bank statements, information from the DVLA, etc. And the point about this is clearly it would be helpful if Dorset Council had clear details of all its previous employees. And the logic there would be that we should lobby our MPs to see if there could be better two-way transfer of information between HMRC and local authorities rather than it just being one way.
Yes, I mean, that's probably...
I think we should look into that, but I don't want to spend too much time on that today.
No, but that's interesting. I'll have a look at that. Obviously, all authorities have the RTI information that's fed to HMRC.
HMRC Connect, and you'll be able to read about it. It's
Yeah.
fascinating.
And we do also sign up to the National Fraud Initiative, which may be linked, and that information is provided to all authorities as well. Thanks very much for that.
Okay.
That's lovely. Okay, moving on to the cost cap review, and many of you will know this has been around for a while. When the government changed public sector pension schemes in 2014 and 2015 from final salary to care schemes, it wanted all public sector schemes to remain within what they described as a cost envelope, and this was to prevent there being excessive charges to the taxpayer. Obviously, the LGPS is the only funded scheme. All the other schemes are direct in and out of the Treasury. When the new schemes were brought in, the cost cap review mechanism was also brought in, and that was done in 2016. The results of that came out in such a way, and I don't think they expected the results to come out in this way, as to mean that the cost of the scheme had gone down, and that meant that there should be improvement to member benefits. And this was being discussed at the time, and the suggestions for what those improvements will be had been laid out. At that time along came McLeod, and you'll be aware of the McLeod judgment, which sort of threw a very large spanner in the works of the cost cap review. I think it's also fair to say that even putting McLeod aside, the government wasn't quite expecting the results to be what they were. And it's very difficult as well. The LGPS has two cost cap review mechanisms. It has the Treasury one and it has its own one as well, because we're a funded scheme. What led on from that was a pause in that process. And there has now been a review of that process to make sure that it's going to be right going forward. And that review has now been published, and the details in the statement is there in the report if you follow the link. And there are suggestions for changes going forward to the cost cap review. So what does this mean? And those changes include things like changing that cost envelope from ±2% to ±3%, just to allow for unexpected changes, etc. So what's going to happen now? Well, it's very difficult because we still haven't had a final decision over the 2016 review. A further review was due in 2020. And we've got another valuation next year as well. And obviously we've got McLeod. So that's the report and the recommendations. And we now wait to see what will happen. It's important that you are aware of this because it is very significant. And it could lead to an impact of us having to change benefits going back to 2014 or to 2016, when the changes should have come into place. So the changes that were suggested were things like the abolition of the Tier 3 ill health, changes to contribution rates, for example. So if that does go ahead, we will have to go back and revisit all benefits since 2016. So we're sort of waiting to hear exactly what will happen there. The next item on the agenda is to do with delays to the new Code of Practice. 24th of August, Pensions Regulator published an interim response to a recent survey. They had over 100 responses to the consultation. Actually, I think that's a typo. I think they had over 1,000 responses to this consultation, and a huge number. You can see over 10,000 individual answers. What they're basically saying here, actually, we've got a lot more back that we thought we would have to work through, and we're going to delay implementation of the new code. So that's not likely to move in until next year. So just to let you know, there is a delay to the new code of practice by the pensions regulator. I've also included here for your information the Commons Committee report on public sector pensions, which was published on the 21st of June. It's for your information. I do think it's interesting. It does cover all public sector schemes, and you can see here the comments and conclusions that they have made. The things that are relevant or specifically of particular interest to us at the time is that HMR Treasury has not done enough to ensure people understand the value of their pensions. And I did want to comment on that point. In the Dorset Pension Fund, we do have an excellent communication strategy, and we do everything we can to make sure we reach all of our membership. Very tricky in the local government pension scheme because we're a very diverse workforce, and as we know, not everyone is full-time, not everyone is based at a computer, but we do make exceptional effort to make sure as much information is available to as many members as possible. And HM Treasury has decided to revisit the key elements of the 2014-15 reforms due to McLeod, which we know about. And obviously HM Treasury has not yet performed the evaluation of 2014 reforms, and the committee is not convinced it is on track to meet its objectives. So those are comments, and they're interesting, and it does rather suggest that there will be further changes ahead for us. Item 16, I have mentioned LGPS mortality data. I've put this in because I felt that you might be interested, and if you are interested, do follow the Scheme Advisory's COVID-19 report on their mortality page. There is some interesting things there, some comparisons. We've been feeding to the LGA for a long time now, our deaths of pensioners each month, and they've collated that information. And they've also had Scheme Advisory Board has published updates and reports from Aon and Barnett Wadding are our actuaries on mortality, and those make an interesting read. They do have some conclusions. So, for example, higher death rates in male members than female members, and they certainly are higher deaths than we would anticipate for this time of year. Whether that will be impactful enough to make mortality expectations change for the next valuation, we don't know. The results of their calculation, excess mortality, they put a figure at 0.2% of pensioner liabilities. And as we know, things can change quite a lot. So we'll wait to see the next valuation as to whether the changes in mortality have had any impact to us. And just to let you know as well about the Governance Administration Survey, the Dorset Pension Fund complete this each year. This serves as a very useful check on our governance. And in all areas, we seem to do quite well. The one aspect that we do have a shortfall on is that we don't have a documented policy to manage board members' conflicts of interest, and this is something that we are working with Hymans Robertson to create for us. I think that's everything on the report. Does anybody have any questions or comments?
Well, as ever, Cameron, that's very, very thorough. And really appreciate the work being put in there.
Thank you very much.
Does anybody else have any questions? No? In which case, we'll move on. Thank you very much, Karen. On to the Fund Administrator's report, on to the Independent Advisor's report first. So over to you, Alan. And for those of you who want the page number, it starts on page 102 of our papers.
Well, thank you, Chairman. I hope you've had a chance to read the report. It was going to be my last report, but I'm now staying on until November, so
Yes, we just can't get rid of you, can we, Alan?
Well, hopefully I can see you all in person in November. I very much trust that will be the case and meet some of the new members. We had a really good training session yesterday. I think most of you made it. And one of the great themes, of course, was inflation and what to do with our inflation and hedging strategy. And to some extent, that I anticipated this investment report today, because the prospects for inflation has been a theme of my reports all through this year. It's quite startling to note that the last report inflation number in the States was about 5.4%. And the Bank of England is now suggesting, instead of a 2.5% outturn later this year, inflation could be as high as 4% CPI. And you're all familiar with some of the dynamics behind that: supply shortages, rising oil prices, oil back to $70 a barrel, etc., etc. This has been a preoccupation of stock markets and bond markets through the year. But despite that, and you would think really this should be a cause of great anxiety in equities, because it does put great pressure on central banks to reverse their policy of easing, injecting massive liquidity into markets for the last 2 years since COVID struck. But on the whole, central banks appear still to be leaning against the wind and taking a relaxed interpretation of the inflation data. President of the US Fed, Jerome Powell, certainly hasn't indicated any immediate tightening of policy. Certainly high short-term interest rates are quite some way off, but we do anticipate there will be some tapering of the quantitative easing that we've had. In other words, when central banks buy back government bonds and corporate bonds, which they've done on a huge scale, thus injecting liquidity into markets. And the Bank of England on its side has said, well, we may start reducing our bond buying, but we're really going to seriously consider reversing quantitative easing when base rates touch 0.5%. They're about 0.1% at the moment. And their projection of base rates hitting 0.5% is 2024, some way off. So that has given some reassurance to markets. We had a bit of a sell-off in July in equities. That was partly due, of course, to the rising incidence of the Delta variant, not just in the UK but elsewhere, which certainly rattled the cages a bit. But since then, markets have rallied back. And we've seen with bond markets, slightly perversely, some strengthening in bond markets. So bond yields have started to fall, having risen very sharply. So the 20-year gilt yield, which we look at, went from something like 0.7 to 1.25. It's now back to 1.1, having been at 1%. That's therefore a response to these placatory noises from the central banks, but also some sense that the pace of economic recovery around the world is just easing off slightly. The June, July, August economic data have just suggested some softening of that strength of recovery, but we're still looking good for this year. I think the Bank of England has said that we will actually reach pre-pandemic GNP levels by the end of this year. They've already done that in the US. And to remind you, the projections now for GNP growth this year is about 7.5%, somewhat greater than that in the US, but obviously we're a long way behind them in terms of overall output levels. And in Europe, also a strong recovery coming through. So all that is good and now taken for granted by the markets. So why are markets holding up so well? And I give some data for what's happened so far this year. Just looking at the latest data, the FTSE 100 is now up 10% in the calendar year to date, but the Dow Jones in the States, which admittedly is a rather narrow index, is up 20%. And that's not due to any great currency movements. Sterling's actually been slightly stronger against the dollar this year. The S&P, a broader index, is up rather less. We've had something of a recovery in the growth stocks. Remember, we had that discussion earlier in the year. The growth stocks, the internet stocks, the technology stocks had quite a sell-off when gilt yields and bond yields started to rise, but that's now reversed itself. The value stocks, these resource stocks we talked about in the context of decarbonisation, had quite a run, quite a recovery in the first half of the year, but now they're now selling off. So where do we stand, therefore? I think markets are now flattening off again in August into September. I feel these are pretty good levels for the year. If we can hold on to these levels through the year, and I think that will be quite an accomplishment. There's a lot of underpinning to that. It isn't just noise about data vaccines and data spreads and economic GMP numbers. Corporate earnings growth has come in very strongly. A lot of recovery there, certainly in the States, ahead of expectations. Dividends are being restored. Banks are restoring dividends. Takeover activity, of course, is on a very large scale. Private equity, we talked about yesterday, seems to be taking up all of our groceries, all of our retailers. The vultures are now allegedly hovering over Sainsbury's. Only Tesco at the moment has been immune from any such takeover activity. So all those, if you like, good supply-demand mechanics behind stock market resilience, which I think can carry on. So I'll now move on, in conclusion, to talk about strategy and asset allocation, but without preempting what Dave will say when he goes through the numbers. You will recall, and Dave will reaffirm this, that somewhat disappointingly, the funding ratio, despite this strong recovery in our risk assets like equities, actually fell from the March 19 valuation date. And we've gone from roughly 92% funding ratio then to about 85, 86%. It's picked up a bit. The reason for that entirely is the implied discount rate change from our actuary, which, as Dave reminded us yesterday, is not the formal one, but it's a dynamic discount rate, and they adjusted according to their changing expectations on the returns of our various assets. And so now say our portfolio will deliver a return over the next 17, 20 years of 4.5% instead of 5%. That lower discount rate inflates our liabilities and thus leads to a reduction in the funding ratio. They brought their assumption more into line with other actuaries, so I can't say that I'm too surprised by that, but it obviously suggests that we haven't made the progress we might have hoped for in terms of funding ratio recovery. In terms of the actual asset allocation, what tactical changes, we're going to have a discussion about that, I imagine, shortly, Chairman, but obviously we got a heads up yesterday from Mercer's about moving into private debt, which joins other private market categories like private equity and infrastructure we're in already. That would seem to be run alongside our multi-asset credit, which is leveraged loans and high yield bonds, and also our corporate bond portfolio. So we need to make a decision about that, and I'll invite some responses there. And the other thing is what to do with our LDI portfolio, and I'll shut up now, but we have more collateral in our LDI portfolio than we need. You saw yesterday with the Insight presentation, Vega presentation, our leverage ratio has come down to about 2 times, as opposed to 3 not so long ago. So, in conclusion, we could either increase our liability hedge back to the 40% we had before we cut it back last year, or we could take some of that collateral away and use it to fund a new initiative in private debt or support our other commitments elsewhere. So those are the, if you like, the options facing the committee in terms of any changes to strategy. I'll stop there and take questions, Chairman.
Okay, Howard, you've been hand up.
Yes, thank you very much, Chair. Alan, yesterday at that training session, you remember that there was an opinion, I think probably, that our private investment at the moment, I think it was at 23%, was it? 20-something percent. And their opinion, it could go up to as high as 50. I was wondering if you had an opinion about that, because that does concern me a little bit.
Yeah, I certainly wouldn't support that. I think that's an outlier. They said that some pension schemes go that far out. I don't think we'd need to. And, we've only recently reaffirmed our 50% commitment to quoted equities, which we're very comfortable about. And they've done us a good job recently. So our chairman did some numbers on what the potential is in terms of our strategic commitment and where we actually are. And obviously we are below because we can't get to our target levels in private equity and infrastructure. And the same problem would apply with private debt, because you're being paid back from successful investments whilst you're still committing new money in. So we're chasing at moving targets there, which is why you need to the commit. But I can assure you, Councillor Legg, no way would I suggest going to 50% in private markets.
Thank you for the reassurance.
Okay, Councillor Christopher.
Yes, Alan, you mentioned inflation and the Bank of England's report, and there's been lots of coverage of the latest members' comments about the fact that there will be a cap on inflation at, say, 4%. Would you like to comment on her words? Is that realistic? We may look down in the mouth as Dorset councillors, but that's hardly a surprise because we keep on hearing about material shortages and indeed the shortage of HGV drivers. So you would reflect on the fact that Dorset councillors are perhaps obsessed with the word inflation at the moment.
Yes, we tried to tease something from Insight, our liability manager, on this recently, and they've written a paper on this, indicating there is upside clearly to that 4% target. And a lot will depend on whether we get into a wage price spiral, which will remind many older members of the dark days of the 70s and 80s. So if the labour market responds to rising price pressures, we'll start to lock in that upward drift in inflation. And at the moment, the Bank of England and the Fed and the ECB, and inflation in the ECB in Europe has gone over 2% as well. They're all saying we think it's short term, it's transitory, and we can manage that transition.
Yes. So in other words, you're agreeing with Mrs. Mann, as it were, the latest recruit at the Bank of England, with her comments that we won't see that 1970s style spiral.
I am agreeing with that, but I have been saying for the last year, I think we're going to overshoot our inflation targets, and we're pretty well by year end where I expect us to get.
Thank you.
Yeah, I personally, I'm worried about this as well, because I think it's not. I think we've got several things going wrong at the same time. I think COVID undermines globalization and free trade across borders, and I think that it impacts prices. Obviously, I think Brexit has also led to some problems in some areas. There seems to be a policy in other countries as well to edge more towards protectionism, or certainly not to go back to the full globalization that seemed to be on the cards 15, 20 years ago. And that therefore imports from places like China and stuff like that probably are going to decline, and that removes some of the levels of competition. And there's a combination of factors which have done very well in driving inflation down are either in reverse or heading in a different direction. And I think I wish in some respects we hadn't cut the LDI holdings a little while ago, but we did. And it's starting where we are. I think it's very difficult to say that these current rates we should plough into having more inflation hedging. But certainly, I'd be very wary of cutting what inflation hedging we've got at the present time.
The implied inflation rate in the markets at the moment is 3.6% on a 20-year view. Now, as Insight reminded us yesterday, after 2030, the government is going to remove RPI and move it to CPIH. So that's suggesting that inflation on a CPIH basis will be 3.6% in 20 years' time. It's hard to really go with that expectation. So markets are getting too concerned about inflation at the long end. And that's one reason why I think we'd be reluctant to increase the inflation hedge, because you're locking in these high short-term inflation numbers at the moment. And we would lose money once inflation starts to go back into reverse next year, assuming that is the outturn. So I think the consensus probably yesterday, but we should invite debate on that, is that we'd be reluctant to increase our inflation hedge at the moment.
Okay. Any other questions, Ryan, at this stage? No, in which case we'll move on to David's report, today's fund administration report, which is a few pages on. So David, over to you.
Thank you, Chairman. I think it starts on page 107. So, as usual, I don't intend to go through this in a large amount of detail. I'll just try and highlight and expand on some of the key points. And I think Alan's already sort of prefaced this a bit in terms of some of the matters arising, if you like, from the training sessions yesterday. Maybe something that we can touch on and get members' views on. One thing to highlight is that you will have noticed that we don't have a presentation from a standalone presentation from Brunel this quarter. We've had their Chief Investment Officer at the last 2 meetings, so I think I gave him a meeting off for good behaviour, and also to make some space so that we can have a good, decent session with CBRE, our property portfolio manager at the end of this meeting, someone that the committee haven't seen for probably a couple of years, I think, actually. So I think it'd be opportune just to, see where we are with property. So some of the headline figures that you will have seen in there is the value of the fund's assets at the end of June was up to 3.5 billion compared to 3.3 at the start of the year. So that mirrors the comments that Alan said about the kind of continuing kind of recovery in financial markets. Alan also mentioned about the funding ratio, which hasn't recovered as quickly or as fully as we would have hoped and perhaps expected. We talked quite a lot about the reasons for that at the last meeting, and it is really just to reiterate what Alan has said, is that the Barnett-Waddingham methodology looks at your expected returns going forward, and slightly perversely, but I think understandably, stronger returns in the short term almost dampen down the longer term expectations from asset classes in terms of Barnett-Waddingham's look forward. The funding ratio has increased from 86% to 85% at the last quarter, so it is starting to tick up, but my expectation is it will still be some way lower than the 92% that the actuary estimated based on the position as at March 2019 when they come to do their next triennial valuation, which will be based on March 2022 data. And I think each and every member within the committee, what the demographics are, etc., and as Karen alluded to in her report, looking at things like changes in death rates, etc., all of that feeds into that big exercise that happens every 3 years. It's also worth, well, I suppose this is self-evident, but the funding ratio is very driven by that discount rate that's used. It's very sensitive to changes in the discount rate, and we're seeing that with these quarterly estimates that we have. And just to highlight again that once we do have those results from the triennial review, as we have done previously, we will then take the opportunity to look at our strategy again and see if there are any reasons or opportunities for us to to make any changes to that strategy, that asset allocation. So in terms of returns, I think over the quarter it's a 6% return, which is outperforming the benchmark by about 1.3%. From memory, I think the last quarter we were slightly under the benchmark, and I think Alan again basically alluded to the reasons for that, is that we did see in the first half of the calendar year some strong recovery in value stocks, which have now leveled off, and the way we've pivoted our investments towards the sustainable approach, we've moved away from having such a large exposure to those kind of value stocks. So I think we've seen that in the quarterly figures, feeding through in the quarterly figures. I'm sure David Vickers, if he was here from Brunel, would be able to sort of expand on that and reinforce that. We've also talked about the inflation hedging. So talked about that at the training session yesterday. So 30% of the fund's liabilities are hedged against inflation sensitivity, but we're only using just over 11% of our assets to achieve that level of hedging. As we discussed yesterday, we have the option to consider increasing the hedging target that we're going for, or to release collateral from that hedge to invest in other things. So that would not change, just to be clear, that would not change the target. We would not be moving away from 30%. We certainly wouldn't be advocating reducing from that 30%, but there is an opportunity actually to take some of the money out that sits behind that and to look to invest that in growth assets. I think there's probably almost an opportunity to even have a mix of the two. So the position on collateral is so strong at the moment that we could take some money away from the mandate and increase the level of hedge slightly as well. I think that will obviously be useful to open the floor to members of the committee just for their thoughts on the inflation side of things. But I think I think to echo the comments that Alan has made and the chairman, is that we would hold fire in terms of where we are at the moment would be our kind of recommendation at the moment. But obviously we're going to welcome any comments on that. One of the things that did come up in the training session yesterday, which I haven't had the opportunity to talk to Alan or the chairman about, is Insight mentioned that several years ago we actually had some triggers in place, so that if the price of inflation hedging, if you like, falls below agreed levels, we would then take the opportunity to increase the value of the hedge. So I think there is some mileage in that myself. As I said, I've not discussed with Alan or the chairman, but I think what I would propose to do is speak to Insight about that and see if we can come up with some perhaps suggestions that we can bring back to the committee in November. But I think I'd be interested in Alan's view on that in particular.
If I could just inject, of course, if inflation does drop back, the leverage ratio will rise. We won't have quite the same freedom that we have at the moment. The leverage ratio has fallen because inflation has risen. The contrary applies when inflation starts to drop back. But I think, certainly by all means, keep that in mind as a reserve power. But I would be happy to recommend some reduction in the collateral for redeployment elsewhere in the portfolio. Then you can see how much flexibility you have to put some trigger points in later on.
Okay, I think what I'd like to do is firstly ask for any specific questions on the report or points on the report, and then we'll go on to talk about what happened yesterday in the training. Okay, so firstly, are there any questions on the report stands or points that anybody wants to make about anything in detail?
Sorry, Chairman, is it all right if I just say just a few more words about the asset allocation, although that does feed into the discussions that will arise from training. So the table on, I think it's page 110, it's under paragraph 10.1, shows you by asset class what our target allocation is and where we are in terms of our actual performance at the end of June. So you'll see that we're ahead in equities by about 2% over our target of 50% of assets, and that has increased slightly since the end of March as well, and it's to do with the as we've talked about already, with the continuing strength of markets. Equity markets has kind of driven that. We are broadly in line for the multi-asset credit and the diversifying returns funds, the 5% and 6%, but we are above target on bonds, so we're 1.6% above bonds, and bonds was obviously one of the things that we talked about yesterday. So again, we'll come back to that when we have the discussion, but there's certainly we're certainly above our target there in terms of bonds, the target that was agreed in September last year. But Mercer were obviously making suggestions about that as an asset class, whether that's still an asset class that perhaps we should be invested in. And also we're underweight across the board basically in private markets. So we have as I said, we heard yesterday about the opportunity to invest in the next cycle of Brunel's private market offerings will be in March 2022, and also Mercer and Brunel. I think another stress that with private markets, the challenge with one of the challenges with private markets is you don't just make an allocation and put your money in, and then you can kind of just keep an eye on it as you would with public markets. You have to kind of continue to make commitments, because the way that the private markets operate is that that you have an investment period where the money is drawn down, then you have a maturity period where the money is returned to you. So there's a lot of modelling and tactical decisions that you kind of need to make to try and achieve those targets that are agreed. And I think it is something that we haven't concentrated on as much as perhaps we would have liked in the last couple of years, because the main focus has been on getting our public markets in order, if you like. The public markets are still the bulk of where our investments are. They are still the main driver of returns that we have. But I think we need to take this opportunity now with the next cycle of Brunel commitments to start addressing that. And I would imagine that we would want to come back in November with some suggestions, some options and recommendations for members to consider how we can best do that. And I think we've also talked, finally, in terms of asset allocation, we've talked about the LDI. So we're actually below our target allocation. So we are delivering that 30% hedge with just over 11%, and the opportunity to take some out of that, to reduce the collateral held up in that and put it somewhere else. So we are below our target on that, but there's no need or expectation to increase that if we stick with a 30% target hedging. So I think that was all I wanted to say, Chairman. So happy to take questions on the report.
Yeah. Okay. Does anybody have any questions or points they'd like to make on the main part of the report? Okay. No one's indicating, but there is one thing that concerns me a bit, actually, and that's the recent performance of Hermes on the infrastructure side of things. They seem to have had a very poor 12 months indeed, which has knocked their numbers down a lot. And I think it might make sense to invite them in to meet with us in November to talk about what's going on there. So I think it's obviously not one of our biggest portfolios, but I think when they're clearly struggling, and I think we need to find out why.
Yes, I'll take that away, Chairman.
Okay, Councillor Christopher, you have a question or point?
Yes, for the benefit of you all, and indeed anybody else who's tuned in. Clearly, when we look through those figures, many of us are somewhat disappointed by the performance of the FTSE. I know it's only a small component of our holdings, etc., but I don't know whether Alan wants to comment on that, the disappointing part of the FTSE. But also in respect of inflation and inflation hedging in a world of scarce resources, I think we need to take that into account. Clearly, we had our briefing yesterday, and we're always hugely conscious of risk and return. But in terms of investment strategies, do we feel our advisors are receiving sufficient information, read asset prices and trading volumes to actually determine our investment strategies? Are we receiving sufficient information about trading volumes, etc., to determine what's actually happening? Because clearly, if we look at private investments, as we saw yesterday, they are very, very illiquid, and therefore our reactions can be deemed to be somewhat slow. They're not easy assets to get in and out of. Would David like to comment on that as well?
Did you want to go first, Alan, or do you want?
Okay, yes. Well, just on the UK equity point that Councillor Christopher made, we have consciously reduced this substantially over the last few years, certainly at the last strategic review, but that carried on a process that's been going on for some. So we now have just 10 out of 50% in UK equities, and some of that is in UK small cap, which has done extremely well for us. One of our most successful fund manager appointments over the last 15 years. So I think we're more in line where the typical pension fund would be now in terms of our UK exposure. I agree. I mean, the UK markets lagged global equities for the last 3 years. reasons we know all about. You make a very good point about the information flow on our private market holdings. We're getting better information now from Brunel, where we've got some small commitments, but I have felt for some time we haven't had enough information back from our private equity managers. And Chairman mentioned Hermes, who have been struggling for reasons we're not fully clear about, and infrastructure. So private equity, I beg your pardon. One of our managers done extremely well. The other, Aberdeen Standard, have also lagged. So I would suggest, Chairman, that you had them in at some stage as well. But of course, now that we have handed over a lot to Brunel, we have another layer of expertise available to us, or to you as the committee. And I think they have staffed up with some first-class people, and they are much more accommodating to our inquiries and questions now than they were perhaps to begin with. So I would say, I think you should be relaxed about the UK exposure. Yes, let's get more information about our private market exposure and our legacy managers like Aberdeen Standard and Hermes. And the door is open, I think, to Brunel. We saw the man yesterday. I was impressed by him, Richard Fawcett. He came out of Derbyshire Pension Fund some years ago, where he had built up his expertise. So I think we are in pretty good hands there.
Thank you.
Okay, Councillor Brown.
Thank you, Chair. Yeah, just looking through the report, just some sort of general comments, really. I always find the asset valuation summary table that David talked us through the most interesting, really, just to sort of keep an eye on the sort of allocations there. And I accept what you say about the equities. It's a couple of percentage points over, but that's, markets move, so not too much you can do about that. But for me, again, it's the corporate bonds which you made reference to. I mean, the 2% over in equities, where it's 52% against a target of 50%, is only about 4% of the target. Whereas when you're looking at corporate bonds, 5.6% against 4% target allocation, that's about 40% over in sort of real terms. So yeah, that's the one that really sort of stands out to me. But yeah, I do find that report, that sort of table, very useful. I suppose the only extra thing on that report which would aid understanding is around the liquidity of those different asset classes. I know, obviously, in the discussions we have, it's all fairly clear to most of us, but I don't know whether anywhere on a separate sort of report we have anything that sort of classifies the liquidity of those different sort of asset classes, where it's sort of, I don't know, liquidity of 1 for cash and probably 10 for cash or something, and 1 for property or whatever it is, whether we have any sort of classifications around liquidity, because that makes reference to the sort of discussions we were having yesterday on the training about the liquidity of private debt. And just on the investment performance summary, I take the points that are made about, particularly about Hermes, where they're sort of below target. But I'm just pleased to see, actually, on the first table in the investment performance summary, that the fund return is up again above benchmark on both the quarter, the 1 year, the 3 year, and the 5 year. So, I think we're obviously doing a lot of things right to be above benchmark on all of those areas. So.
That's why I was hoping to get out at this meeting, so I could get out at the top. You see, anything could happen between now and November.
Quit while you're ahead.
If I can try and respond to those points sort of briefly, I think you're right to highlight corporate bonds, and I think some of the history of corporate bonds is that I think 2 valuations ago our allocation to corporate bonds was 12%. I think we then took the decision to introduce a new asset class, multi-asset credit, and we effectively split that allocation in 2 between bonds and multi-asset credit. And then the review that we did, that was agreed back in September a year ago, we took a further decision to further reduce the corporate bonds down to 4%. I think we also said that was kind of like a holding, if you like, with potentially looking at private debt as a longer term asset class that we might want to move all or some of that bond holding into, and but we decided not to make that decision back in September 2020 because of the Brunel cycle of investments meant that there wouldn't be an opportunity to make a commitment to private debt until March 2022 anyway. So we purposely kind of put that on the back burner, and yesterday's training was kind of part of the process of bringing that forward and looking at that again. The immediate question would be, what would we do with that? So it's, in cash terms, it looks like it's about nearly £60 million over target. So the question then would be, where would we put that if we were looking to trim corporate bonds? So we're already 2% over on equity. We could put it in equities, but we're already 2% over our allocation. The private markets, by their nature, are illiquid, so we can make a decision to say that when the opportunities in private markets come up, we will divest from bonds and invest into those private markets. But until those opportunities come up, until we've made those commitments, we don't really have anywhere to move that money into. So bonds have perhaps held up better than people have expected over the last few years, and the performance from our bond manager has been very good as well, I would say. Alan, if Alan, I'm sure Alan would agree with that.
We have a first-class manager, no question about that, for London. And actually, over the last few years, you look at the tables, we got a 7% return from our corporate bond market, only 3.5% from our multi-asset credit manager. It's the latter who's disappointed, which was an appointment which diversified us away from corporate bonds into high-yield bonds and leveraged loans. They haven't done so well. But I quite agree with Councillor Brown. We want to trim the corporate bond holding as and when we make commitments to other asset classes. That's an obvious shoe-in. I'd also be happy to take a 1% out of equities where we're overweight, and another 1% out of our LDI portfolio. So I think we can access 3 or 4% where we're overweight in asset classes to fund any new commitment like private debt, for example.
Okay.
Moving on to the liquidity question. Yes, I think we could perhaps incorporate something in there to give an indication of liquidity. I mean, simplistically, the equities, basically all the way down to diversified returns, are liquid with the cash. So we do have a very high percentage of our assets are liquid. However, so if we needed to, we could sell down equities quite quickly. However, what we don't want to be, the nuance really is, we don't want to be in the position where we're a forced seller, where we're having, whilst we can sell those things, we don't necessarily, we want to be able to choose when we divest from asset classes. We don't want to be forced into a situation. And that can be an issue with the LDI mandate. So when there are collateral calls, that you are then put in a position where you have to try and find that cash. And the same with our FX hedging as well. So I think I mentioned before the call went public about losing my hair, but I think where I lost most of it was shortly before I think it was just after the results of the EU referendum, where currency markets were going haywire, and we had to find some cash very, very quickly to close out our hedging positions on currency. So liquidity. So it's easy to say that 75% of our assets are in liquid holdings. Therefore, that's fine. What we need to be a bit more nuanced and avoid those situations where we're forced sellers. Is what I would say in terms of cash management, if you like, rather than liquidity. We do have quite a high cash balance as well in there. We don't have a strategic target to cash, but we do have quite about 60 odd million pounds worth of cash. That can change quite quickly. Sometimes there are quite lumpy drawdowns that we have on the private markets that come through quite at short notice. So we need to be mindful of managing the cash and also about the opportunities of where we are over target on asset classes. What would we do with that? Where do we put that money? And trying to read my own scribbled handwriting about the last point was I think more of an observation about the performance, the absolute performance and the relative performance to benchmark. I think it is pleasing, because I think putting the clock back a year perhaps, I think we were struggling against our benchmark, in some cases. So So it is pleasing to see that those have all moved to positive, both absolute and relative. Thank you, Chairman.
Thank you. I think yes, we've definitely had a good 12 months, and I think that really shows out on the performance table very clearly. I think what I'd like to do is now go on to discuss what we discussed in the training yesterday. Firstly, all right, Councillor Roberts, yes, have you got a point?
Well, I've had an RTS up for a while, Chairman.
Have you? Sorry, I can't see it. Please go ahead. Sorry.
Oh, perhaps it hadn't come through. But it was really, I wanted to comment. You mentioned about Aberdeen standard and the disappointment, and no one's mentioned the sort of outstanding performance of HarbourVest. And really, should we be thinking about doubling our investment with them? I know it's a higher risk one, but the performance is just outstanding. And I think Aberdeen perhaps deserves to be switched into HarbourVest, looking at the results we've had really from inception. And I can't see that Brunel are going to match it, although it's very early days for their private equity. I wonder what your thoughts are on that.
Can I make a stab at answering in the first place? I think this comes to the nub of private markets in a way, and one of the challenges. If that was the case, say in listed markets, and we have made that decision before, as you'll recall, Councillor Roberts, then we chose to divest from Investec. Actually, that's quite easy to implement, but in private markets, one, to divest from the private equity is very difficult, and you would probably take a reduction in terms of you'd have to find a secondary buyer to take your ownership, and you may not get a very good price for that. And then to actually invest the proceeds in the preferred manager, again, you would go back to making commitments to future vehicles for you to invest in. So unfortunately, it's not as easy to do that as it would be in public markets.
Thank you for that explanation, but I would be happier to see an increase into the allocation for HarbourVest.
Okay, that's a good point.
If I could just come in.
Yes.
You're quite right, of course, to draw that distinction, Councillor Roberts. I should just, though, mention that HarbourVest is measured in dollars, unhedged, and Aberdeen Standard, I think, in euros. So there will be some currency impact, which might partially explain why the figures are so divergent. But it doesn't take away from the fact that HarbourVest have done a great job, and we were happy to put more money in as and when we are asked to by HarbourVest. But we did, out of, as we said yesterday, to be polite, as it were, to Brunel, we tried to help them in the early stages when they launched their private markets by giving them some money to their private equity, and same with infrastructure. So we made that sort of gesture.
Thank you.
Okay. Thank you. Yes, I'd like to move on to what we were talking. Oh, sorry, Peter. Yes.
Thank you, Chairman. There may be no sensible time to raise this, so can I raise the issue of national insurance? I know as a pension committee, we absolutely always try and take the longer term view, but we won't meet again for 3 months. It is likely that there will be a national insurance rise, which will have some fairly major impacts on some equities and some other asset classes that we're dealing with. Can I ask Alan to give us an off-the-cuff response in terms of if we were to make any response, what would it be, and where does he think it might have an impact upon our assets? Thank you.
Thank you. That's quite a curveball, because I hadn't really thought about it. Other than as a pensioner, I don't pay it, and I think that's wrong. I think I should be paying it on my modest remuneration. But,
the latest news is that pensioners will pay national insurance.
Yes, I agree.
Earning pensioners.
Personally, I think that's correct.
Yeah. But let's not get into the politics of it. But I'm
Yeah.
concerned about are there any effects on our asset classes? And let's at least discuss it now, because otherwise it will be 3 months' time when we discuss it.
Well, employers will bear the burden as well, won't they? So you could say that will impact on profits and therefore on earnings from our equity exposure, UK equities. But as we just discussed, that's only 10% of the portfolio. Don't think it will have any impact on our bond holdings. So it will squeeze economic activity a touch, I suppose. But I would be pretty relaxed about it.
Okay, good. And good response when you put on the spot there. Yes, well, I think what I'd like to do then is to move on to discussing what we learned yesterday. And firstly, if we have a discussion perhaps around the idea of contributing towards Brunel's class 3, I believe they called it. They want to do
Cycle
it.
3.
You've got
Sorry?
Simon Christopher. You've got Simon Christopher on RTS.
Yes, just to contextualise about Peter Wall's question, that impact on national insurance might be perhaps, it's just a conjecture, greater felt by the great employers of the land, the targets of the private equity companies, i.e. the supermarkets, as opposed to perhaps the miners of this world.
Okay, yes, fair point. Right, yes. To get on to the proposals from Brunel and what they're planning to do with, what would you call it, class? I call it class 3. What do they call it?
Cycle 3, Chairman.
Cycle 3. Okay, yes. And do we find what they were talking about interesting that we want to do, both in terms of the private debt as a new instrument, or topping up into the other funds that they're planning to launch as well? So if we have a discussion about that to start with, bearing in mind that we do have cash, we do have potentially a surplus from LDI, and we could be willing to sell corporate bonds as well. So the question is whether this all fits in together into a slight alteration in what we want to do. But I have to say I'm nearly out of power on one of my two laptops, so I'm going to have to leave the discussion on one and rejoin on one that's got slightly more power. So Peter, if you wouldn't mind just chairing the next little bit of the of this debate and these issues while I quickly change machines, okay?
Of course, thank you.
Thank you.
So who is scheduled to speak next?
Would you like me to give a quick sort of summary of my own views?
Yes, please. Thank you, Alan.
I was a bit sceptical, quite frankly, because the Mercer paper yesterday gave relatively low-ball expectations about returns of about 4%, not very different from the multi-asset credit exposure. And as we discussed yesterday, this is an illiquid asset. You're locked in 5 to 7 years. So we do expect something called the illiquidity premium, such as we get from private equity, i.e. a higher return. However, when we heard from Brunel in terms of their projections, it turned out to be net of all fees, and fees are lumpy. If you remember, councillors, the gross return was something like 8.5%, but the net return was 6%. So a 6% return, I think, is an adequate liquidity premium over what we would get from multi-asset credit or corporate bonds, and so therefore I felt more comfortable. They are on the whole relatively good quality, and they are often protected by covenants and by holding collateral charge. So all that should give you some comfort. They're quite senior in the debt structure. You should bear in mind, those of you who have any sort of societal reservations, they're often used to fund private equity deals. And there is an argument that private equity deals cannibalize companies and leave them slightly stripped of assets and everything else. That's something you might wish just to factor into your considerations. But as a pure asset class, as a diversifier away from corporate bonds and multi-asset class, I think I was sufficiently persuaded to say, yes, I could support the commitment.
Fine. Andy, you've not missed much, I don't believe, except we've had an interesting analysis from Alan. We've got Adrian Felgate with the right request to speak.
Okay.
Back to you, Andy.
Thank you, Chair. Thank you, Vice Chair. I think the main points that I got from the training yesterday was that we were talking about moving from fairly liquid to an illiquid state, and that to maximise the return that we could get from this illiquid class, we would have to invest over a cycle, which would be 5 to 7 years, and there would be a series of points where we would drip money into the fund in order to give us resilience. And so I thought if we're returning by estimate some 6% and a 4% by Mercer, that it doesn't represent an enormous improvement over what we've been able to achieve in the corporate bonds as we've seen today. It was highlighted that the fees that we pay on private equity were very substantial compared to other asset classes that we have. And it was noticeable that with the cycle 2 private equity from Brunel, they had to employ an external company to manage that, and therefore the fees were doubled effectively compared to what Brunel are telling us that they can do when they're going to manage internally. So I have an appreciation of risk there. What happened from the training yesterday is that the cycle 2 was going to be managed internally by Brunel, and then they had a loss of a staff member or two, and they felt that they had to employ an external manager there. If we arrive at exactly the same situation come November or March next year when the cycle 3 goes aboard, we could find ourselves committing to an illiquid thing or an illiquid asset which has higher fees on it than we would be prepared to do otherwise. So I would caution us, if we are going to go down this road, of saying that we wouldn't want to invest in such a vehicle unless the fee standard or structure was compatible with what we wished. I think that's all I want to say.
Yes, if I could respond, the manager was just selecting the underlying funds. There'll be 5 or 6 underlying funds in that, and they were charging 30 basis points. So the total charges were 2.3%. That 0.3 will now drop away. So the charges altogether stacked up amount to about 2%. I think Fanshawe, the boss, has sufficient experience in this asset class, though, to cope should he lose the manager who presented yesterday. So I would be fairly relaxed about that.
I think it's also worth reminding ourselves that the returns that were quoted by Mercer and by Brunel were net returns as well. So yes, the fees undoubtedly will be higher and significantly higher than, say, investing in keeping money in bonds or in multi-asset credit. But ultimately, it's the net return that's the one that's important to us.
Okay. Any further comments? Howard.
Thank you, Chair. I'm betwixt and between on this one, and maybe a question would help me sort this out. What sort of amount of investment would be thinking of putting into this this third tranche? Because I don't want it to be too large, because I do think there's a bit more risk there. But on the other hand, I do think it deserves some. And am I right in the first lot we went into, we actually had 2 lots of 60 million and nothing in the second lot? What sort of idea or what figure would we be putting into a third one if we went in for it?
Can I try to answer that? I'm not going to answer it fully with pounds, shillings and pence, I'm afraid. But so private, if we decided we were going to make an allocation to private debt, Mercer have suggested that you wouldn't want to do any less than 5%. Now, our lowest allocation that we've got at the moment is 4% to corporate bonds. So 4 or 5% would be what you'd be looking to allocate to private debt. Then you would need to do some modelling in terms of likely cash flows, in terms of whether you make a commitment for the full amount of that into this cycle 3, or whether slightly less or even slightly more. I think the point you made a point yesterday, Councillor Legg, about sometimes you need to overcommit in order to hit your targets. So firstly we'd need the committee would need to agree a change to the strategy for private debt, and then we'd have to look at the mechanics of how are we going to actually get that money into the ground. So we could, in terms of the other options that are coming up, cycle 3, my view on it is that we've already made the allocation to those asset classes, be it infrastructure, property, or private equity. So secured income kind of cuts across infrastructure and property. So I think we should be looking to make commitments to at least to private equity and to one or possibly both of the other two cycle 3 opportunities, infrastructure or secured income, in order to try and achieve the asset allocation that you as a committee have already agreed. But again, I can't answer your question in terms of how much I think that should be in terms of cash at this meeting. I guess what I would suggest or propose is that we come back with some figures and some options for the committee to discuss properly in November. Bear in mind, the commitments don't need to be made until March in 22. Brunel are looking for indications as early as possible so that they can kind of firstly see that there is a demand for those cycles and what that level of demand is likely to be. So, which I appreciate, but I think if we're able to discuss and hopefully reach some agreements in November, I think that would tie in with their timetables.
Can I come back on that one, Chair?
Yes.
I wanted a cash figure. Okay, I don't mind saying we'll delay it. Only as an idea, by the way, not as a proposal. I just wanted to get some grip on it as to what sort of figure we might be talking about or discussing. But fine, we'll wait until November or maybe another one after that. But we also need to remember in that we're actually getting some of the returns from the cycle 1 coming back in shortly, I imagine, and that those can be reinvested in the same sort of asset class. And when you do come back with some figures that we chew around, can you please highlight how much of that would be from other classes that we invest in at the moment, and also how much it would be reinvestment from that class 1?
Well, I think there's two slightly different things here. Firstly, within the current asset allocation policy, if you look at the funds which are illiquid, we're about 4% underweight compared to what our target is. So within our current strategy, we talk about moving about 150 million pounds into those asset classes just to get us to where we're supposed to be trying to achieve in the current strategy. But then on top of that, there is a separate decision perhaps to be taken about private debt, which would be a new asset class and a new percentage. So what David is suggesting is that we might want some money to top up on infrastructure and private equity, that sort of thing, and then a separate 5%, so I guess another 160, 170 million pounds for private debt on top of that. So there are two parts of that, one of which is a change of strategy, which will be buying private debt, and one of which is not a change of strategy, it's just topping up where we're currently short. Does that help at all?
You've put another way exactly what I was inferring.
Okay. I mean, yes. I mean, I think David's right. We don't have to make any firm commitments today. We can ask for officers to go away and speak to Brunel and say that what we're principally just interested in doing, and we can talk about some penciled in numbers so to give Brunel the comfort that we are serious about this, but emphasize that at this stage we're not 100% guaranteed that we're going to do this, but we're in principle minded to do it, assuming the range of funds is available and they work on the timescale that they're working on. Does that sound reasonable to everybody? Alan?
I think Mercer's would probably recommend we just sell out our corporate bond holdings, which is 4%.
Yes. Yeah.
And reinvest in private
Yes,
debt.
I mean, yeah. We have got, as I said, a reasonable amount of cash. We've got the surplus funds in the collateral on the LDI, and we've got the corporate bonds. So there is potentially quite a bit of money between those three sources to do what we're talking about doing. It's just a question of doing the number crunching and making sure it all adds up. David.
Thank you, Chair. Yeah, I mean, just go back on the sort of discussion about private debt yesterday. I was minded to sort of, having listened to Mercer's and the sort of presentation from Brunel, it sounded quite persuasive. I think for me, one of the most interesting points was about the vintages, as they called them, which I thought was a very useful term to understand the sort of investing in a range of vintages, because particularly I think when he put up the chart about returns, I think there were returns on private debt very high in sort of 2000, 2001, 2002. But then he said, oh, but if you went in 2003, it was quite low. And I think that's my only wariness, that you don't want to be in the situation where suddenly everybody's talking about, oh, you need to get into private debt, look at these great returns. So you pile in and suddenly you've missed the boat, because everybody's piling, etc. So I think that's it, rather than a sort of reactive, oh yes, we need to be in this, it's more of a strategic, thoughtful, yes, we need to have that sort of asset allocation, and we need to phase it over the coming years so that we have a variety of vintages. We don't want to just sort of pile in and find that we've picked the wrong time to go in. It's all about timing, isn't it? My only other comment, I found actually Alan's comment just a moment ago was quite interesting about the type of private debt where it's often to sort of fund buyouts, etc. And just a little bit of understanding about the types of investments and types of deals that you would be getting involved in terms of the private debt market. I mean, is it as a football fan, a lot of the football clubs have been taken over and funded by debt. Is that the sort of the type of deal? I'm not saying it would necessarily be funding a buyout of a Premier League football club, but is that the sort of thing? I suppose when they were talking about it, I was under the impression, oh, you've got businesses that are there, they need to take on debt to expand or to invest in capital, that sort of thing, and they're successful running businesses. Is it more that, or is it more funding buyouts of businesses and organisations?
If you remember, they showed a chart with the percentage of sponsored deals, and those sponsors were the private equity firms engaged. But it won't just be in the UK. Of course, it's going to be European and US. So it'll be a global exposure, and they will hedge out the currency risk. But this is the territory you're in. We're in that territory already with private equity. So just be doubling up with private debt. I just thought I should give you, the environment that you are going to find yourselves operating within.
Yeah.
Okay. If there's nobody else, then what I suggest is that we go ahead and look at participating in principle in phase 3 to top up where we're a bit short in private equity and other such things. And we also open negotiations about that we're willing to invest in private debt as well. But at this stage, we don't commit to any specific numbers on private debt. So I think Councillor Brown has a good point about we wouldn't necessarily want to all pile into the first wave and we want to build up the position over time. So that sort of gives David and Alan an opportunity to go and talk to Brunel in detail and we'll pursue those avenues. Does that sound reasonable to everybody? Yeah. Okay. You're not there. So good. Okay. Then the next part of this is the LDI position. Obviously, Insight were very good at presenting some alternatives, including possibly either increasing the inflation hedge or taking out some of the collateral. Personally, I as hinted earlier on, even though I'm quite negative about inflation, I find it quite difficult to justify increasing the hedge at these sort of current levels. I certainly do feel the collateral could be used more productively somewhere else. So maybe that's the approach we need to go down. But what does everybody else think, having heard that yesterday? Councillor Legg.
I just want to say I agree with you. I don't want money being kept aside for a rainy day that's not likely to be used. I'd rather put it to some other use now. And I think that our inflation hedging, from my layman's point of view, but I would hope an informed layman, is that we're high enough already, and therefore let's use that collateral, as you say, or at least some of it, on other investments.
Okay. Does anybody disagree with that point of view? No? Again, lots of so, well, that's the recommendation then. Bit of a shorter debate than I anticipated, but it's the important thing is that we're all agreeing about the way forward. Okay?
I think Adrian had asked to speak, or is that?
Oh, sorry. I see that, Adrian.
I did. Sorry. Yeah, it was just to confirm that I was entirely comfortable with staying at 30% hedging and making the collateral that was mentioned yesterday in Insight available for reinvestment elsewhere.
Okay, good. Okay, well, thank you very much for that. That's the end of that main part of the item. We have an opportunity for Councillor Beasley to fill us in on latest developments at the Brunel level and nationally perhaps as well. Any other comments you'd like to make?
Well, thank you very much, Chairman. I will be relatively brief, mainly because there's been very few meetings and updates during the course of the height of the summer, and it's always the case in this quarter that there's less to report. And of course, our incidence of timing for the Dorset Fund isn't in line with either Brunel or the Scheme Advisory Board. So towards the end of this month, the Brunel Oversight Board will be meeting. We last met on the 1st of July, so some time ago, and the Scheme Advisory Board likewise not until the end of September. So anything I've got to say is a little bit historic in that context, but I don't think there's much we can actually do about that. I think it's quite interesting to note that we at the end of June in Dorset had transitioned 62% into Brunel. Assets under management with Brunel across the 10 constituents are now around 28 billion out of a total of 37 billion. And so that's 76% transitioned across Brunel. So slightly ahead of us. There are good reasons for that, as we all know, but I think it's easy just to see that as a snapshot that more importantly, I think the other funds are performing in terms of their transition, whereas before there were two who notably were lagging the curve as far as Brunel were concerned, and those are now being brought up to comparable levels. They've got a little bit of a way to go, but I think the movement is all in the right direction, and that in turn I think leads me back into the debates that we've been having at the Oversight Board with regard to governance over some period of time. And I think that uptake in transition indicates that most of those issues are now resolved for the time being, and that those governance issues have not only been addressed, but that some of the changes that have taken place as Brunel has moved forward have now accommodated those. I think colleagues will probably recall that I've said before, when we set up Brunel, we did have to make the caveat that we would go back and review quite a number of issues as Brunel progressed, and predominant in there were the governance issues. They were untried, they were untested, they were set out at some pace because we had to move quickly. And I think the work that's been undertaken since then has paid dividends in terms of the confidence of not only the members of the Oversight Board, but also the shareholders. So combine those two forces, and I think there's a far more confident step to Brunel at the moment than there was before. Alongside that, the non-executive directors on Brunel now number 5 against the 4 executive directors, so the balance is in the place that it now should be. And I keep in regular touch with the chair of Brunel, who's one of those 5 non-executive directors, Denise Le Gaulle, in terms of making sure that we understand fully where we are at the moment and any issues that are emerging as far as Brunel, particularly around governance, are concerned. So I've got much greater confidence about that sure-footedness than perhaps I and members of this committee had a year or 18 months ago. And I think what's important to remember is that, yes, there was a situation with a number of changes amongst the senior management and the direct non-executive directors of Brunel, and the coincidence of those happening all at in a fairly short time frame did lead some to question their confidence. That's now been resolved. I think there's greater stability. There's certainly a very high degree of professionalism, and I think what came out earlier in this meeting, actually quite important to remember, is that the management of Brunel is now far more sure-footed than it was in terms of the range of expertise that's now been recruited. And I think those lessons are now accepted for the future. So all important stuff. In terms of the Oversight Board itself, of which obviously we are one of 10 participants, there's been, as a result of the May elections, quite a lot of churn. And so that has made a difference in terms of the personalities actually on the Oversight Board. And perhaps we will see over coming months, but perhaps the attitude that they have to the direction that Brunel is taking as far as the Oversight Board is concerned. And I think that's a positive thing, personally. The churn involves, I think it's 5 of the 10 parties who were there previously being changed. So that, as you can imagine, with any kind of committee, can lead to some fairly fundamental change going forward. But I look upon that as being relatively positive, particularly at a time when I hope and expect that we have resolved those governance issues for the time being. Just a few words, if I may, Chairman, about Scheme Advisory Board. Same caveat, we haven't met for quite some time, so pre-summer, and again we will be meeting at the end of this month. At which stage, I think there will be some updates on a couple of issues that I expect are of interest to this committee. You'll recall I've mentioned before that there's been a call for evidence on the social impact of investment from Department of Work and Pensions, and the Responsible Investment Advisory Group on the Scheme Advisory Board are formulating a response, and amongst those from Mercer are somebody known to a number of us in the form of Nick Buckland from Mercer's. And we're having input into that, so I think quite important. And there may be other changes being rehearsed in the background about the positioning of the LGPS as far as government departments are concerned and government in general, because whilst in our experience Brunel is progressing along the lines that we had all set up and expected, the passage hasn't been quite so consistently true across some of the other pools, and we're not, I think, as a result, getting the message across to government as we would all like to about the sustainability of the current pooling system and the advantages to the LGPS as a result, not just in terms of funding expectations, but also in terms of management and long-term performance. And so there's a lot of work going on through the Scheme Advisory Board and the LGA to try and address those issues with government, because unless we have that confidence, then we're always going to be on the back foot in terms of their thinking. And as we all know, in the past, that hasn't been to our advantage, and we've got to make sure that we can turn that around. I'm confident we will, not least because of some of the other work that's taking place at the moment. And I would hope to be able to report back on that at our next committee in November, Chairman. Any questions? Happy to take them.
Well, thank you. Anybody have any questions? No. In which case, we'll move on to the external auditors report. David.
Thank you, Chairman. I'll try to be brief on this because we've got our property managers, CBRE, waiting to join us, and I think we want to try and devote as much time as we can to their bit. So those with longer memories will remember when the Pension Fund's annual report for 1920 was approved by the committee in November 20, we noted that the report of the auditor included in the annual report had not been received, although no major findings were anticipated. At that meeting, it was resolved that we would circulate the auditor's report to committee members when it was received, but that the annual report is published as is, and that a delegation is made to the chairman and vice chairman of this committee to approve the final version if no substantive matters are raised in the auditor's report. We now have the draft final report of the independent auditor for 1920, and we do not believe that this identifies any substantive matters. However, it is the draft final report. It is not their final report. We had been promised that final report by the end of August, so we had hoped. The reason for including this on the agenda today was that we had hoped that we would have that final report for you to see. So whilst I don't anticipate any major changes from that report, that is in draft at the moment. There are some minor what I would call minor items in there that they've identified, and within the executive summary we've included the management responses to each of those three, I think it is, findings, which I would categorise as fairly minor points. So overall, actually, the report is pleasing, and it gives a level of assurance, hopefully, that we have good controls over the contributions we get from our scheme employers and the benefits that are paid out to those members, and in terms of the valuation of assets as at the end of March 2020 was fairly robust, or it does note some greater uncertainty due to COVID, but of course, to be blunt, due to the lateness of the report being published, most of those concerns have gone away. As we've seen, the asset value is now 3.5 billion, whereas at the end of March 20, it was in the region of about 2.7, 2.9 billion. Happy to take, whilst time is pressing, I'm happy to take questions on this if anyone has them.
I think the stress is that it is incredibly annoying from all the officers' point of view that this has taken so long to get this audit finalised, and this has been taken up by the Audit Governance Committee at Dorset Council with the auditors, and I think they'll be pressing to hopefully improve the situation in future years. Is there anybody else who wants to say anything?
Councillor Christopher.
Yes, you will have seen my RTS. With respect to the conclusions, where it talks about Appendix 2 identifying 2 uncorrected misstatements and 2 disclosure deficiencies, particularly with respect to the 2 uncorrected misstatements, where it talks about the auditors seeking representations. Do we get to see letters of representations? Do we get to see letters of representations that are sent to the auditors?
Can you? Sorry, I'm not quite sure what page you're.
This is the page which has the key messages: the audit quality, the going concern, and the conclusion. Happy to talk about this after the meeting.
Yes, I think that might be the best way to do that. It's probably.
I think it'd be useful to see the letters of representation.
Okay.
Thank you.
Yeah, I'm sure we can follow that up after the meeting. Right, I'll move on then to dates of future meetings. We just have, sorry, yes, Councillor Brown.
Sorry, I don't want to take too long, but just I noticed the draft report, but page 17 of the report, which is page 223 of ours, talks about IT audit findings, and it just says to be updated. So that's obviously part of the report they still haven't done, which is in draft. in terms of our sort of system changeover, I don't know whether we're anticipating any kind of adverse IT audit findings, but not, like you say, it's not very helpful to have a blank page there, is it really?
Yeah, and I don't believe so, because this is a reminder. This is for the 1920 accounts, and the changes in systems that Karen's talked about earlier actually didn't occur during that financial year. So potentially the report for 21-22, whenever we may, sorry, 2021, whenever we may receive that, may have some, you know, that I suspect there will be a focus more on systems in that audit, given the changeover and therefore the risk that all data does transfer across from the old system to the new. So I don't anticipate any IT audit findings for 1920. 2021, I would imagine they would want to do a bit more work than what they would otherwise have done.
Okay, thanks.
Okay, right. I think we'll move on then to the dates of future meetings.
We only have one in the calendar at the moment, Tuesday the 30th of November. We're anticipating that will be at County Hall, but obviously that is you know, subject to confirmation.
Yes.
So and sorry, I was just saying we need to set up a meeting for March as well.
You certainly do that. Then move on to exempt business. So we'd like to move into exempt business, ask for the ending of the recording, and any members of the public to cease to be part of this at this point. I've had a couple of requests to have a short comfort break before we hear CBRE. I would like to say 5 minutes. Just those people who want a short break will do so. So we'll start again at in 5 minutes time. Okay.
Thank you, Chair. Martin, can you confirm that the broadcast has been turned off? Or all right, thanks, Martin.
Do we need to rejoin as usual for exempt?
You should be able to continue. So I've just. Oh, sorry. Do you mean?
Normally we shut one meeting to ensure there are no members of the public still involved.
There's a broadcast of the meeting is being broadcast, or has been, and we're just shutting that broadcast. So then it will revert to being a closed meeting.
Okay, thanks.
Yeah.